Hi Moneymakers, it's Talking Sense David, a place where complex finance is made easy for all. In this video, I want to talk about variable interest rates and fixed interest rates, and I want to highlight the key differences between the two. Let's start with fixed rates. What exactly is a fixed rate? This is when you, the borrower, decide that your interest rate needs to stay the same over the loan period and you agree to a slightly higher rate that is fixed for the loan term. Usually this is the case, but in some jurisdictions they will only allow you to fix your interest rate for 5 years. This allows you, the borrower, to know what your monthly payments will be. The next one is a variable interest rate. This is where your interest rate fluctuates over time, causing your loan payments to change. The reason for this is because your interest rate is attached to an index, such as a prime rate, and the prime rate will change depending on market conditions, and these fluctuations, as mentioned, influence your interest rate you pay on your loan. Let's look at the key differences between the two. Let's start with fixed interest rates. The benefit to the borrower is that they can bank on the stability and the predictability of what loan or payments they need to make in that time frame. However, they need to accept that the interest rate will be higher. Compared to variable interest rates, the benefit to the borrower is that the interest rate will be lower, but they need to be comfortable with the risk that the interest rate can fluctuate and change over time. Alright, let's look at some key considerations when you are thinking about taking a fixed term loan or a variable term loan. The first thing you need to take consideration of is your risk tolerance. If you are somebody that's going to sleep better knowing that your payments stay the same for an X amount of period, that might be a better option for you. But if you are someone that can handle a bit of risk, or you have cash reserves, maybe opting for the fluctuations of a variable interest rate might be better. The next thing to consider is your budget. How are interest rates going to affect your budget? If they significantly spike or unexpectedly start rising, how is that going to influence or affect your household income? The next thing to consider would be your long-term financial goals and how the interest rates will affect that. One important thing to also think of is the terms and conditions of the loan and what the creditor has put in the contract before signing. Ultimately, for me, the deciding factor would be the long-term interest rate cycle. So depending on where you are located, in what economy, where are the interest rates going, where are they today, and how are they going to influence your budget in the long term. Alright, let's summarize what we learned in this video today. We looked at fixed interest rates and variable interest rates. Fixed interest rates stay the same, they offer higher interest rates and predictability. Variable interest rates fluctuate over time and there's more risk associated to that. What you need to consider are long-term interest rates and where you think they're going, and also realize that banks also understand these dynamics, and this is why they would offer a higher interest rate compared to where it is today, to also cushion themselves in case interest rates significantly spike and you've locked it in a lower one. So it's not necessarily as easy as that. Lock it in, hope for it to go up, and you score the difference. So take some time to consider these facts, read through them, look at your budget, and consider your long-term goals. If you have any questions, feel free to comment below. In future videos, I will be looking at other property concepts that might interest you, so don't forget to subscribe. But for now, I'll see you in future videos. Bye for now. Don't forget to subscribe to Talking Sense for more financial content.